All right, it's time for the August real estate market update. We've got a lot to cover. It has been quite the year so far. So diving right into it, the Fed actually had their meeting for July. They held the rates stable. And now all the markets are pricing in potentially a 0.25% rate drop for the Fed at their September meeting. We'll see how it goes. One of the big jobs reports just got revised down by over 250,000 jobs. So that was a big change. American Eagle jeans seem to be the topic of many discussions right now. And the bond market has actually been dropping, which has pulled mortgage rates down with it. So that is a little bit of good news for home buyers. But I will say one of the most common headlines that I've been seeing lately talks all about the huge amount of real estate inventory, highest levels of real estate inventory, more sellers than buyers. But what does that really mean? So as I always say, let's look at the story behind the story. So for right now, just like and subscribe, follow the channel. Thank you very much for all the support. I've had quite a few responses and comments. Folks really appreciate trying to keep things unsensational and really look at the data from an impartial angle, look at it from multiple different directions. What does it actually mean? How could it impact you without all the crazy headline and attention grabbing sensations? So I will do my best to continue that. So let's talk about the jobs data. So we just saw it revised down by 253,000 jobs. That's a pretty big revision. Markets did react, and we are starting to see the impact of some of the tariffs that went into effect back in March. We're starting to see a lot of that cycle through our economic system and come around. Consumer spending is softening up a little bit with the high cost of housing and other things. It's just not leaving a lot of discretionary money available for consumers to keep buying. Tariffs are changing that. Cost of some goods. Inflation is still around. So that may be part of the reason that the Fed decided not to drop rates at this meeting. So the other thing, some reports are showing lower trade numbers, but it seems like a lot of companies had a backlog. They pre-ordered a lot of inventory anticipating tariffs going into effect. So they do have some inventory. They're able to soften that change and continue to provide goods while they are planning for their next big purchase with new tariffs in place. So I think, again, housing affordability, very low housing affordability is putting a lot of financial strain on folks. And that's part of the reason we are seeing that consumer spending change. So a couple more articles that I've read. Currently 20 out of the nation's 50 biggest metro areas have more housing inventory now than they did pre-pandemic. So what does that mean though? Yes, it grabs the eye. I would say prior to the pandemic, we had a pretty normal level of inventory. And during the pandemic, we had very, very low inventory, incredibly historically low inventory. So to say that we're back, we have so much housing inventory that we're back to pre-pandemic levels, not really a bad thing. That's when we had a nice, reasonable market. Things were moving. Buyers could find great homes. Sellers could get a fair price. It was working really well. So going back to that, not a bad thing. Many of the areas right now, though, that we are seeing the high inventory levels and a little bit of the price drop, a lot of those are coastal and southern states, southern cities and metro areas. So a lot of the Midwest is doing well. A lot of buyers are looking at the Midwest because it's more affordable. They can get better cost of living, better affordability there. So keep an eye on those. If you're somebody that's thought about that, I would say just, really dig into all the other things that you don't see in addition to the price of the home. How's the insurance? How's financing? What about property taxes, state income taxes, cost of living? And then always just the creature comfort. How far are you from an international airport? Is it just completely flat fields everywhere? Do you actually get some nice landscape? So think about the big picture. Additionally, so there was an article by Resi Club. They said that 1/3 of markets across the US are seeing a decline in home values. And then checking both lists, many of those areas do correspond to the markets that have an excess of inventory. Keep in mind that even a 0.5% decline in values is still a decline. So again, look at the story behind the story. Were these 10 to 15% drops, or was it less than 1%? Either way, they got you to read the article. And I came up with I just made this up. The word decline gets the headline. Remember that. And look at the story behind the story. Anyway, if you're interested in the Midwest markets, I'd say, as an investor or maybe for relocation, just dig into the data, check with some professionals in the area, read some blogs, see what's going on there, and then make your decision. So another thing that I saw, one of the larger YouTube channels that focuses on housing and a lot of charting and a lot of fancy data, he just used a phrase in one of his updates, and he said that homeowners or home sellers are hoarding equity. And words always matter, right? What's the connotation of the word? Hoarding definitely has a negative connotation, and I didn't like that. I don't think that homeowners are hoarding equity. I think if the market dynamics were more favorable, they would be glad to take that equity and move on. A lot of folks have been in their homes much longer than expected because of market dynamics, because of rates. They're not hoarding it. I would say they're protecting it. And many of them would like to move or like to make a change if they could. The other thing he said was that the real estate market, the US real estate market, home values need to drop by 15 to 20% to bring the housing affordability rate back into line and make the housing market more reasonable again. And while I do agree, a 15 to 20% drop, just some mental math, would absolutely improve affordability. The challenge that we run into there is the harm that it would do to the majority of the homeowners that purchased a home over the last, give or take, 4 or 5 years, depending, and obviously this depends, how much they put down on the home. They put 20% down, 30, 40, 50% down, right? That could change things. But that drop could potentially wipe out a lot of the equity, and it could definitely lead to a significant increase in the number of foreclosures, which can have a cascading effect. So a bigger foreclosure market, not great for anybody, not great for the economy, not great for the housing market. So it would be better to avoid that. And I would say right now, my best analogy is basically that the current housing market is taking a day off after they had the big holiday party, right? So it's not moving quite as well as it should be. It's not feeling as great as it should. There's definitely a little bit of discomfort and pain. It's not really bad, but it's just moving really slowly, and it's going to take some time to get back to that, 100% efficiency. So this is the hangover after the party, and we had a great couple years, but the bill comes due. So anyway, back to that point about equity. The sellers have the equity, it's there, and they can choose to sell at this point and maybe take a little bit less of that equity than they hoped for, or they can make the decision. It's their house, it's their money. They can make the decision to wait. And I do expect we're going to see a lot of sellers over the next couple months that are going to pull their homes back off the market. We've seen this huge run up in inventory, massive increases in inventory. But I think a lot of those sellers, they're testing the market. They might do a price reduction, they might not. And they're going to pull that house back off the market and wait to see what happens in 26 or 2027. So yeah, we have a lot of headline and discussion around the high inventory, but it might be short-lived. So anyway, let's watch over a longer time horizon than just 2 months. Let's watch the inventory levels. Let's watch the market. And again, I don't follow a lot of the other metro areas around the US as closely as I do the Sacramento market. So for most of this, I'm talking about Sacramento. Other areas, they might have a tough time. A lot of those southern metro areas that I mentioned, they are seeing some getting close to double-digit year over year price drops. So, and I think some of them are seeing, 10, 11, 12%. Not great, but those are also the areas that got really, really overheated. Anyway, enough of that. Let's talk about the auto market, because you guys know I love to keep an eye on the auto market and the commercial market. The auto market right now, 90-day delinquencies are still at or near highs that we really haven't seen since the 2010 financial crisis. The good news is that they aren't increasing. They've kind of stabilized for now. So we are seeing very high delinquency rates, but it's stabilized. We'll see how things go over the next 12 months. The other thing for the auto industry, the tariffs on steel and aluminum and import tariffs could have a direct impact on a lot of the automakers and the auto dealerships. So really going to squeeze the margins on new vehicles, and either the dealerships and manufacturers are going to have to eat that and try and just slim their profit down as much as they can, or some of that they're also going to pass on to the consumer. Well, if the consumer is paying more and more and more every year for new cars, I think a lot of them are going to opt for maybe a resale vehicle instead of brand new. Now, the challenge with that, the rates on new vehicles are much better. Rates on resale vehicles are much higher. So, it's really going to be interesting to see how that plays out. A lot of pieces to that puzzle, and I think we're going to have to watch the Fed because that'll impact the rates on auto loans, watch the tariffs because that's going to impact the cost of some of those vehicles. So overall, there are a lot of moving pieces to watch coming up in Q3 and Q4, but I would say there might be some really great buying opportunities both in the housing market and potentially in the stock market. Speaking of housing, let's dig into the local market. So here in the Tri-County area, July saw a 0.3 increase in the number of homes for sale, 6.6% increase in the number of homes pending, and a 6.5% increase in the number of homes sold. So good data, strong. That's what I would expect to see right in the middle of summer. Very normal for this time of year. As I said, let's see what happens once we get the full August numbers. We may see a little bit of a pullback heading into the fall season. So days on market in the Tri-County area increased from 36 to 40 days. And the sold price to list price ratio held stable at 97%. And just a quick recap, this is the sold price to original list price. So if a home is listed for $750,000, seller drops the price to $700,000, and then it finally sells for $700,000, that is not a 100% list price to sale price because the original list price was $750,000. So that would be less than a 100% ratio on that one. That held stable at 97% in the Tri-County area. So on average, some homes, again, some sell for under 97%, some homes sell for over, but that's the average right now. Median sales price actually dropped 1%. So it dropped from $610,000 in the Tri-County area down to $604,000. Very normal for July data after the spring run up. Nothing to be concerned about there. We did see a 3.4% pullback in the months of inventory. So the region dropped from 2.9 to 2.8 months. Not a huge change, but that may be a leading indicator of what I mentioned earlier, that a lot of sellers are going to start pulling their properties off the market and try to wait for next year. So digging into Placer County specifically, we see a similar but slightly different story. Homes for sale dropped 1.6%. The pendeds dropped 1.8%, but the number of homes sold increased by 8.1%. So pretty big jump there. So looking at that, that is lagging sales data. Home sales, obviously those were home sales from potentially late June through all of July, and then they finally sold in July. So most home sales, I'd say, average between 21 and 30 days. Some are 14 days, some are 45 days. That is a lagging indicator. So the days on market in Placer County, not much change. It only went from 39 to 40 days. And that's still that's a really strong market. I remember when I first started 22 years ago, we used to write 12-month listing contracts with our sellers because homes they took months and months to sell, and that was normal. 40 days for marketing time, not too bad. The list price to sales price ratio also held firm in Placer County at 97%. The median sold price in Placer County, though, dropped 0.6%. So it went from $703,000 down to $699,000. Not a huge change, pretty normal for the month of July. So months of inventory did see a little bit larger drop in the Tri-County area. They went from 3.2 months of inventory down to 2.9 months. Again, a lot of sellers tested the market, didn't get the price they wanted, and maybe they dropped the price once, maybe twice, maybe not at all, decided to pull their property off the market. So overall, in summary, I would say we're following seasonal trends. Don't get too concerned about all the headlines. That being said, the real estate market in our area is fairly, and I hate to use this word, but it is fairly stagnant. I don't expect us to pull out of this slump for probably another 12 years. I'm sorry, 12 months, 12 months, not 12 years. I'd love to see what happens once we get into spring of next year, see how that spring market starts to shape up. But again, I watch this stuff closely. If I do see something that really breaks our normal data trends, I will absolutely be letting you know. and keeping an eye on those things. But again, 1 month doesn't make a trend. So I'm going to continue to watch the market, watch all the data as it shapes up, and keep you guys advised as well as I can on where our market might be going. So thanks again. Hope you enjoyed the August update, and look forward to bringing all this information to you with some updates next month.